Okay, so tonight we're going to cover Chapter 10 in preparation for the exam. Last week when we were talking about Chapter 9, at the end we were covering time value of money. Thank you, Catherine. Remember we were talking about time value of money, present value of $1, future value of $1, present value of an annuity. And an annuity is a repeated stream of payments, the same amount. Future value of the repeated stream of payments. And you may have gone, well, so what, right? Tonight we're going to actually apply it. We're going to do one of my favorite things. We're going to cover bonds. And as you recall, bonds is another way that companies can borrow money. Remember the primary types of financing for a company is going out to stockholders, selling stock, and bringing in money from a large group of people. That's the equity portion. The other concept was borrowing money from typically banks or insurance companies, pension plans, things like that, right? The third way is issuing bonds, and that's where you go out and you borrow money in small chunks from a whole lot of people to get your hands on a lot of money. And that's done through bonds. The bond is a piece of paper. It's basically a promissory note. The corporation says, I promise to pay, so-and-so X amount of dollars at some point in the future with interest. And it's a whole contract. There's a lot of language on the bond. It's on the front, it's on the back. But in its most basic format, it's just that promise to pay. And the corporation is borrowing money from whomever, an individual or whoever is willing to lend them money in exchange for that bond. Okay? So tonight I want to focus on how those bonds get valued and how much we as an individual would know to pay for that bond or sell it for if we're making that investment. On the company side, how much do we record it for and how do we deal with the interest expense that goes with it? Okay? They're very common, so there's a whole chapter dedicated to it. New phrase I want to throw in, capital structure. Capital structure is what we talked about before. It's the borrowing that the company does. Either it's from the shareholders, or it's from banks, or it's from bonds. More follow me, less follow slides. We've gone through that with Eric already. Okay. There are pluses and minuses that go with bonds. Remember what we talked about before. If you're borrowing, as a company, if you're borrowing primarily through equity, selling stock, the stockholders get their return on the investment through dividends. If the company's not doing well, they don't have to declare and pay out a dividend. If you borrow the money either from a bank or through bonds, the interest is mandatory. You have to pay it. And if the debt comes due, I promise to pay you May 31st of 2013, well, that's the end of this month, right? You have to pay off that debt when it comes due. You can't say, oh, I'm not declaring a dividend, I don't have to pay it. So you're forced into a promise, something that you have to commit to. You're committed at that point is what I'm trying to say. Whereas with equity financing through stock, you can choose to not issue a dividend and things like that. So that's the risk part of going out and issuing bonds or other types of debt. Remember, we've talked about cash flows slightly, but we're going to talk about that more when we get to, I think it's Chapter 12. On the downside, if your company's not doing well and you've issued debt, you have to make the interest payment. Well, what if you don't have the cash? It can create a real cash flow problem for you. On the plus side is the interest expense for the money you borrowed, that's tax deductible. Dividends, are they tax deductible? No. Okay? Dividends are an after-tax item. Good? Questions? All right, some terminology, some words that you need to know. Bonds have a principal amount. All these words are synonyms. They mean the same thing. Principal, par value, face value. right on the front of the bond, it's going to say, this bond is for $1,000, or I promise to pay $100,000. Whatever the amount is, that's the face value, or the principal amount that's being borrowed. The face value, it's called. Okay, they all mean the same thing. Also, on that bond, it's going to say, I promise to pay an amount of interest. Let's say 10% interest. It's written right into the language in the contract that is the bond. And since that bond is a contract, it's referred to as the contract interest rate, the stated interest rate, same thing, coupon rate. And they all mean the same thing. If someone says market rate of interest, that's different. That means the bond can have a stated interest rate of 10%, but if the market interest rate is 12%, everybody wants to earn 12% on their money, notice there's a difference between the two. So know that the stated amount and the market amount can be different. It comes into play when we value the bonds here in a little bit. Okay. Market yield, effective interest rate, that's what I'm talking about as the market interest rate. I'm sorry. Yes. The difference between the stated interest rate and the market interest rate causes a price difference in the bond. You're not going to pay the full face value. If it says $100,000, you may pay something different. And you'll buy it at more or less than that $100,000 to drive your interest rate to the market interest rate, forcing an effective yield. We'll do some examples of it. More terminology. And again, remember, bonds are contracts. Okay. More terms. Different types of bonds. These are all bonds, but they are different kinds. Debenture bonds is a type of bond where the company borrowing the money doesn't pledge any assets if they default. Right? If you or I went down and got a car loan, the car is pledged as collateral, right? If we don't make the payments, they come take the car. Well, in a debenture bond, I didn't promise you anything. If I don't pay you, I don't pay you. So this is typically done by companies with real good credit rating, great reputation, your IBM type companies. Secured bond is where somebody's got to pledge an asset in exchange. Here's a bond, I'm going to pay you X amount of interest, and if I don't pay you, you can come take my headquarters located in North San Jose or whatever. Or Mountain View if you're Google, right? Okay. Callable bonds. A callable bond is one where typically bonds always have a stated life in the contract. The bond is going to be for 10 years. I'm going to borrow the money for 10 years. I'm going to pay it off. They may put in there a provision where they can call the bond early, meaning they notify everybody that bought the bonds that they want to pay them off. So if 6 or 7 years go by and they decide we've got a lot of cash, we want to pay it off, they'll notify everybody we want to call the bonds. And everybody brings their bonds in and they start writing checks. Okay? Here's the interesting one. Convertible bonds. Convertible means that in the contract on the bond, the person holding the bond has an option to convert the bond to some sort of equity ownership at some point in time. Maybe they'll trade it for common stock or preferred stock. Remember when we talked about earnings per share at the bottom of the income statement? There's common earnings per share and there's diluted. And the fully diluted, things like this can happen. People can convert their bonds into stock and it would change the earnings per share because there'd be more shares. Okay? The two are linked. And there's reasons why you might want to do that. If you own a bond and you think the company is being run very poorly and you're worried that you won't get paid back, you can convert your bonds into stock, and then all of a sudden you have a right to vote. and you have a say as to who the next CEO is going to be. You can change how the company is being run if you own enough bonds that you can, get your hands on a lot of stock, right? But you at least can convert to stock, and then you have a say. Good? Questions? Yes?
So is this something that says it right on the bond?
It's in the contract on the face of the bond. Here's a very small one. I wish the screen was... They came and monkeyed with the screen. Nice thing is we got a new screen. The bad thing is it's way small. But in here, in the contract language, in this little tiny language, it says all of this stuff. What your rights are and what you can do.
So it's all the same, the company, all the bonds it issues are the same type? Or can one company issue?
You can issue different, just like that you can have common stock and then preferred stock A, preferred stock B, preferred stock C. You can issue a bond series this year and then issue a different set of bonds next year with different rights. And and the year after that and the year after that. You can do whatever you want. So they can all have different rights, and you need to know which one you're buying into. Okay? Other questions? Okay. Here's the caveat, though. I said you can do whatever you want. A bond is treated very much like financial statements for a publicly traded company. Publicly traded companies have to publish financial information that's audited. They have to adhere to all the rules set forth by the SEC to be publicly traded. Bond issuers are typically publicly traded companies, but they have to follow some rules as well. They have to put out a prospectus, just like a company that's going public. Here's who we are, here's what we do, here's what we're going to do with the bonds. And they always run it through some third party who's the trustee of the bond sale. It's always some big brokerage firm, Shearson Lehman kind of guys. And they'll sell the bonds on behalf of, let's say IBM. And then they give the money to IBM. You get your shares, the money goes to IBM. They make a fee for doing that. Okay? All right. Here's where the whole present value topic comes into play. Let's say we want to invest. We've got some extra money and we want to invest. And we know that, I'm going to stick with IBM. IBM's issuing some bonds. How much would we pay for those bonds? Let's say the bond is $100,000. Okay? I know you guys are students, but let's pretend we've got $100,000. Okay? It's more fun that way. It's worthwhile. The bond says this is a $100,000 bond for 10 years. I'm going to pay you 10% interest twice a year. Okay? So they're going to pay you interest 2 times a year, semi-annual payments at 10% for 10 years. How much would you pay for that bond? We don't know, right? Well, you do know. The 10% I gave you a minute ago is the stated interest rate that the bond pays. If the market demands right now 10% return on their money, market rate and the stated rate are the same, then the present value of that bond is $100,000. It's worth face value. That makes sense, right? Because if you did the present value calculation of all of the money that you would receive, it would come back to $100,000. We'll do that calculation in a second. If the stated rate is less than the market rate, think about that for a second. The bond will pay you 10%, but investors demand 12% return on their money. Would they be in a hurry to buy that bond? No. So what happens to the price of it? It's going to go down, right? That's pretty straightforward. Nobody's going to really want to buy it. They want to buy things that pay 12%. So the price will go down. Okay? On the other hand, if the market rate is less than the stated rate, so the stated rate on the bond's going to pay 10%, but investors right now are willing to settle for an 8% return on their money. What are people going to do? They're going to want to buy that bond because it pays higher than what they're willing to accept, right? So the price on it will get bid up. Okay? That's the concept behind it. Go.
That again.
Yes, actually,
I'm not sure I get that.
I'm just going to hit it quick, because as we do the calculations, it'll become really obvious how it works. But I just want you to get the concept. So if the bond says it pays 10% and the market demands 12, people aren't going to be excited about that, right? Oh, I really want to earn 12%. Why do I want to buy your bond? Okay, yes, I will buy your bond, but I'm going to pay you a lower price for it. Right? That's how they'll compensate for that.
How do you define the market rate of 12%? How is that defined?
There's always a market, right? There's a bond market just like there's a stock market, and you can go out there and see what bonds are trading at. One of the benchmarks is the U.S. Treasury, and if you listen to the radio or even on TV, they talk sometimes about there was a Treasury bond sale today, and the bonds were selling at a market rate of, and they'll tell you, 5.25%, 4 3/4, whatever it is, they'll tell you, and that's what investors are buying them up at.
So that's true for corporate bonds too.
Corporate bonds as well. Okay, so these markets, these exchanges exist, and you can look at what market is based on what other people are doing. Okay. On the flip side of what I just said, the bond will pay me 10, but the market is trading at 8. People who are trying to get into the bond market are going to be jumping all over that because they want to earn 10 instead of 12. Here's an opportunity, right? So they're going to end up bidding up the price and paying more than face value, that $100,000, to get that bond, that extra interest. Okay?
A lot of people say that they pay more than face value, so it's not like they put them on sale for an out certain time?
No.
It
See,
fluctuates with the market.
there's always a fluctuation. There's almost always a difference between market interest and stated interest. And here's why. Now, bless you. Think about this. There's a period of time that goes by. Let's pretend we're IBM. Okay, we're the company now. We're going to go issue some bonds to borrow money. Okay? We need to put together this prospectus. We need to go find this trustee. We need to cut a deal with them. While this is going on, we have to kind of guess at what the interest rate will be on the day we anticipate making the sale. And we've got to have the bonds printed up, and they go through a printer, and it takes time, and so several months will go by. And then there will be a sale date. So let's say today is, May 1st, and we decide we're going to do this. It may be October 1 or October 31 before the bonds actually sell. So we have to make an estimate of what we think the market interest rate will be in the future, and we put that estimate on the face of the bonds as the stated rate. Now, from previous classes, what do we know about an estimate? They're always wrong. Okay? So there's almost always a difference between stated rate and market rate. And if you ever do hit them dead bang on, there's probably going to be some sort of Guinness guy there to, make sure it gets in the record book. Okay?
A large discrepancy where the stated rate is much less than the market rate, they can withdraw before they go for sale?
Yes. Yes, if there's a huge discrepancy.
They can rescind after that point of sale.
But, if you were in a period of high inflation, the difference between the two could be tremendous by the time you get to market.
Right.
Okay? And IBM could back out of it if they don't want to pay that high an interest rate. Because they do end up paying market rate, and you'll see that in a minute. Even if it says, I'll pay you 2%, they end up paying market rate, whatever that turns out to be, 12%.
But again, it could be low stated rate by the contract, right?
Well, they're going to pay it at this rate,
At least.
but investors are going to buy it at a discount or pay a premium, and that's going to adjust the interest expense that IBM will end up paying. Okay? We'll see how that goes. We're going to do the calculations. So, the easiest example is one where that really hyper rare example where the stated rate and the market rate are the same. So here we go. This company, Burlington Northern Railroad, they're going to issue $100,000 in bonds. They have a stated rate of 10%, annual interest rate. The bonds mature in 10 years. Interest is paid semi-annually. That's twice a year. The market rate is 10%. Market and stated are the same. How much will the bonds sell for? They'll sell for face value because the two numbers magically are the same. Okay? Now, why is that? You guys want to do an example? Somebody got a calculator? Okay. So who's got their book? Appendix A. You need to do two things when you calculate the interest. I'm just going to jump to it. Okay. You calculate the present value of the principal. So we've got the principal amount of the bonds, or the face value of $100,000. I'm going to draw this out though. One, 2, 3, 4, 5, 6, 7, 8, 9, 10 years. Okay? I'm going to lend them $100,000 here. I take that back. I'm going to lend you some amount of money there. You're going to pay me $100,000 out here in the future. Okay? So if we go to the table, or Appendix A in the book, and we look up present value of $1, we want to calculate what the present value of this $100,000 is brought all the way back to today at 10%. Now there's a minor modification we've got to do here. Does the book have a column for 10%?
Yeah.
Yes.
Okay. How often is the interest paid? Twice a year. So how many periods do we really have? 20. Right? Twice a year. But if we're calculating it twice per year and the interest rate is 10%, you need to convert it to a twice a year interest rate. So it would be half. So the interest rate is 5. Does everybody understand that? Did someone say no? Anybody? Okay, good. Is there a 20 years in the table? No. No. Yes? I have a yes and a no. 20 periods. 5%.
Yeah.
What's our factor? 20 periods of 5%.
I thought it was 10%.
3769.
Hang on. 0.3769? Okay. Who said that? Okay. There are 10 years. 10% at 10 years. But in the problem it states that interest is paid semi-annually. Okay? So it gets paid twice a year, and to do the calculation, remember our calculation of interest? Interest equals principal times rate times time. Okay? If we're calculating the interest on this bond, it's 100,000 times 10% times our time is for half a year because we're doing it semi-annual. So it's 6 over 12 or a half. I'm just combining these and modifying.
Oh, okay.
And then looking it up in our table. Okay? But if I cut it in half a year, 10 years times half a year is actually 20 payments. Right? Okay, that's where I got to 20.
No, but I'm asking why would it be by 5%?
Half times
Okay.
10% is 5. Okay?
Gotcha.
You've got to match your You've got to convert this from an annual interest rate to a semi-annual interest rate, and then you're good to go. Good. Okay. So, yes.
So the rate's going to be whatever it is for one time period, whatever your
Time period is, yes.
Okay.
So if it was paid quarterly, you would be dividing by 4. Okay? Good? Okay. So our factor is 0.3769. Everyone agrees? Times our amount of money that we're going to get in the future. So the present value of this is how much?
37,690.
$37,690. So another way to say that is, if you went to the bank today and put $37,690 in a savings account that paid 10% a year, in 10 years you would have 100 grand. Good? Everybody follow? Okay. Now I need color. Now we have a second part of this. That's just the first part. That's calculating the present value of the principal, the face value of the bond. Right? We're going to get $100,000 in 10 years. What else are we going to get from buying this bond? We're going to get payments every 6 months. Right? Of how much? Well, here's what we know. We have a stated value on the bond of 5%. I'm sorry, of 10%, correct? Yes. So it's 10% per year. But we're going to get paid twice a year. So we want to convert this to a half a year, which is 5%, correct? Based on the formula that we went through over there. So my interest is, again, interest equals principal times rate times time. My principal is 100,000. Good. My rate is 5%. Already converted for the time. What's 100,000 times 5%? $5,000, right? Does everyone agree? Okay. So what's going to happen here is this company, we've been calling it IBM, is going to pay us $5,000 every 6 months for 20 years. I'm sorry, 10 years, 20 payments. They're going to pay us $5,000 20 times every 6 months for 10 years. Everybody follow me? So this, I'm going to get these payments on top of getting this $100,000 10 years from now, right? So this is a stream of payments, and I need to know the value of that stream of payments, the present value of that. What does this look like? It's an annuity, right? It's a consistent payment of the same amount on a regular basis for a number of periods. So we have to go back to Table A, or Appendix A, and look in the present value of an annuity table for 20 periods, 5%, and we get another factor. And what's that one going to be?
12.4622.
12.4622. You agree? Okay. We take the 12.4622 and we multiply that by the interest payment we're going to receive, the $5,000, and that gives us the present value of those payments. Can somebody do that math for me?
62,311.
62,311. Okay. I'm going to take the 62,311 and I'm going to add it to the present value of the final payment of $100,000, or of $100,000, yes. 62,311, and we get 1060. 0, 0. So what's the present value of all of these payments when you take into effect the interest rate? $100,000. Did you guys see how that worked? So when the stated rate matches the market rate, the bond is worth face value. Okay? Now let's change the game. Everybody good with this?
How much did that bond cost initially?
$100,000. The bond has a face value of $100,000 at 10% interest. And when the market interest rate and the stated interest rate are the same, you're willing to pay face value. And I just proved it.
You pay $100,000 and 10 years later altogether you get $100,000.
You get two things. I get $5,000 every 6 months for 10 years, and I get $100,000 at the end. Okay? So we calculate the current value of it by calculating two things. The present value of all the payments plus the present value of the final payment at the end. Okay? That's probably the easiest way to say it. All right, let's change the game. In the book, is there a 6% column?
Yeah.
Okay. I'm going to erase a couple of things. Now here's the one thing that never changes. The interest that they're going to pay us will always be $5,000 in cash. Why is that? The stated interest rate on the bond is 10%. Even if the market rate went to 12, I'm going to change this right now. Market is now 12%. When IBM makes these periodic payments every 6 months, how much are they going to pay us? It's still based on the contract, the 10% written right into the document. So we're always going to receive $5,000 in cash every 6 months, no matter what the market rate is. Good? And there's where the price difference comes up when the market rate is different. Okay. Market rate is now 12%. Our factor is going to change. If you go to the table and look up present value of $1, we still have to calculate the present value of that final payment of $100,000 at, and remember we cut it in half because it's semi-annual payments, 6%, 20 periods. What's the factor?
0.3118.
0.3118. So this is $31,180. It's worth less, right, than what we had a minute ago. So what we're saying is we only have to put $31,180 in a bank account at 10% interest for 10 years to get $100,000 at the back end. It's less because the interest rate is higher. Everybody follow me? Bless you. So in the same vein, we now have to value all of the periodic payments, the annuities, at the different interest rate at market, 6%. And what is that factor?
11.4699.
Okay, so stop there. At 10%, the factor was 12 point something. At 10%, it was 12 point something. At 12%, it goes down to 11 point something, meaning the payments are worth less money now when the interest rate is higher. So can someone do the math for me? I'm just going to round because we're using a table that only has 4 digits. There'll be some rounding errors that going on here. So 57,349 is what that stream of payments is worth. And I add that to the present value of the final payment, the $100,000, and I come up with a new total.
And $98,529.
Okay. So look at what just happened. The stated interest rate is 10%. The market demands a 12% return on its investment. What would you pay for that stream of payments? Less than $100,000. Everybody see that? So people are going to pay less for this $100,000 bond. They're going to pay, much less to get that stream of payments because of the interest rate differential. Good? Notice what else is going on here. The big payment, $100,000, the present value of that is only $31,000. The individual payments of $5,000 that comes every 6 months is worth more than the final payment of $100,000. Kind of interesting, right? Okay, does everybody see how that worked? Questions? All right, do you want to flip it and do it the other way now? Is there an 8% or 4% in the table?
Yes.
Okay, we're going to do it now if the market interest rate changes and is below face value. Let's go down to 8%, right? Our semi-annual interest rate is 4%. Everybody understands that, right? So what's our factor at 4% for 20 periods on a present value of $1?
0.4564.
0.4564. So all of a sudden, this $100,000 is worth $45,640. It's worth way more than the $31,000 that it was worth at 12%. Okay, now I keep saying it a different way on purpose. This means that at 8%, if we put $45,000 in a bank account for 10 years, we'll have $100,000 at the end. Now think that through. At 8%, I have to put in more money to get to the $100,000 than I had to at 12% because I earn more interest, right? So it's logical as to what's going on here. Everybody follow me? Okay. What's the present value of our annuity, our stream of payments?
13.5903.
5903. Notice right out of the gate, this number is 13 instead of 11. So again, more money now because the lower interest rate. Somebody do the math for me?
67,951.
67,951. So I've got 9, 5. All of a sudden, that bond is worth $114,591. Did I do my math right? I'm off what? I'm off 1,000. Still, it's worth $113,591. An investor would pay more than $100,000 to get a $100,000 bond. Think about that for a second. What's the logic there? You promised to pay me $100,000 in 10 years. You're going to pay me 10%, but the market is only 8%. Because I want to earn more money, I'm going to bid the price of the bond up. Right? Just like when the market rate demanded a higher price, the bond price got bid down. So what I want to show next is that all this works out in the end because by paying $113,591 for this bond, what I'm really going to get in the end is 8% return on my investment. I invested more money to get the same, therefore my return will go down. And if I invest less money to get the same, my return goes up. Okay? So I want to go through that and show you how that works. Good? Okay, questions?